At the edge of the abyss, the United States teeters on the precipice of financial ruin. Escalating interest rates, uncertain Fed policies, and a fragile economy converge, posing a grave threat to its financial stability. As American companies rush to file for bankruptcy, Vice Media and Envision Healthcare, the urgency to avert catastrophe intensifies. How can we steer the nation away from this brink? What measures should be taken to restore economic strength? Join us in this video as we'll delve into companies' bankruptcy in the United States. The United States is currently teetering on the brink of bankruptcy, grappling with a complex and intricate web of economic challenges that pose a grave threat to its financial stability. The nation finds itself amid a crisis fueled by a combination of factors, with escalating interest rates and the policies implemented by the Federal Reserve, Fed, playing a pivotal role in exacerbating the situation. In the last 48 hours alone, a startling development unfolded as 7 American companies, namely Cox Oil, Monitronics, Kidfenwall, Athenix Inc., Venator Materials, including the once popular digital broadcaster Vice Media and Envision Healthcare, hastily filed for bankruptcy. This surge in filings represents the highest number of companies seeking bankruptcy protection in 2 days since the infamous 2008 financial crisis. According to Bloomberg's comprehensive analysis, these bankruptcies were identified based on companies with at least $50 million in liabilities. The gravity of this situation cannot be overstated, as it signifies the financial distress experienced by major corporations operating in the United States. The rising interest rates have significantly impacted businesses, making it increasingly difficult for them to meet their financial obligations. This, coupled with the Federal Reserve's policies, has created a challenging environment for companies, pushing them towards the brink of insolvency. The impact of rising interest rates is reverberating across industries, placing immense pressure on companies as they face challenges in renewing loans and bonds. The situation is further exacerbated by the heightened scrutiny from both investors and creditors, intensifying the financial strain on businesses across the board. As a result, an increasing number of companies are resorting to filing for bankruptcy, which serves as a distressing indicator of a broader economic downturn in Western markets. Vice Media, a company that had previously been valued at $5.7 billion, has announced that it will be acquired by a consortium of lenders, including Fortress Investment Group, Soros Fund Management, and Monroe Capital, for a sum of $225 million. The decision to file for Chapter 11 bankruptcy protection allows external partners to submit competing bids that may be higher or better for the company. Despite the bankruptcy filing, Vice has assured that all of its brands, including Vice and Vice TV, will continue to operate and produce content. It is worth noting that the Chapter 11 filing does not encompass substantially all of Vice's international entities or its joint venture with A&E. This development represents a strategic move by Vice to address its financial challenging while preserving its core operations and brand identity. By agreeing with the lender consortium, Vice aims to secure the necessary financial support to navigate the bankruptcy process and emerge as a stronger and more sustainable entity. The surge in bankruptcy filings comes at a time when companies are grappling with the effects of higher interest rates. Central banks have been implementing measures to combat rising inflation, which has added stress to businesses already dealing with cost-cutting measures and staff reductions. This combination of factors has created a challenging environment for companies across various sectors. According to Eric Schiffer, the CEO and chairman of Patriarch Organization and Reputation Management Consultants, the recent announcement of bankruptcy filings are just the beginning of what he refers to as the 2023 iceberg carnage. He believes that these filings are a direct result of the Federal Reserve's interest rate adjustments aimed at curbing inflation. However, the secondary fiscal effects have inadvertently led to casualties among brands that were ill-prepared to withstand the financial challenges that arose. Envision Healthcare, a leading physician staffing company that provides medical personnel for emergency rooms, surgical suites, and ICUs, filed for Chapter 11 bankruptcy early Monday. The company, which is backed by private equity firm KKR & Co. Inc., intends to restructure its parent company and its AMSUG ambulatory surgery unit, ultimately separating them into two distinct businesses. Approximately 60% of Envision's healthcare lenders, who hold around $7.7 billion of the company's debt, have already reached agreements with the company. Envision Healthcare was acquired by KKR in 2018 in a deal worth $9.9 billion. However, the company has faced significant challenges that have adversely affected its financial health. The COVID-19 pandemic led to a decline in patient volumes, while health insurers excluding Envision Healthcare from their networks further impacted its operations. Additionally, the implementation of the No Surprises Act, aimed at preventing the practice of balance billing, was characterized by Envision Healthcare as flawed and detrimental to its financial position. Moreover, a nationwide shortage of clinicians and rising inflation have further strained the company's financial viability. The bankruptcy filing by Envision Healthcare is expected to be one of the largest in the healthcare sector, reflecting the magnitude of the company's financial struggles. As a result of the bankruptcy, KKR's approximate $3.5 billion stake in Envision Healthcare is anticipated to be entirely wiped out, according to the Wall Street Journal. This development signifies the immense challenges faced by healthcare providers, particularly those operating in the physician staffing segment, as they navigate a complex landscape impacted by the pandemic, regulatory changes, and market dynamics. The bankruptcy filing is a strategic move by Envision Healthcare to address its financial issues, restructure its operations, and potentially emerge as a more financially stable and resilient entity. In the past 11 months, the Fed raised the federal funds rate, FFR, at the fastest pace since the 1980s, aiming to curb high inflation. This tightening of monetary policy is part of the Fed's efforts to maintain stable prices and maximize sustainable employment. By increasing interest rates, the Federal Reserve tightens monetary policy, making credit more expensive and reducing consumption and investment. As a result, firms adjust prices and inflation decreases. Monetary tightening by the US Fed plays a crucial role in managing the country's economy. It refers to the process of reducing the money supply and raising interest rates to control inflation and promote overall economic stability. When the Federal Reserve believes that inflation is rising or that the economy is overheating, it may implement monetary tightening measures. This typically involves increasing the target federal funds rate, which influences short-term interest rates throughout the economy. By raising interest rates, the Fed aims to make borrowing more expensive, which in turn reduces consumer spending and business investments. This can help curb inflationary pressures by slowing down economic activity and controlling excessive price growth. Monetary tightening also has implications for financial markets. Higher interest rates make bonds and other fixed income investments more attractive compared to riskier assets like stocks. As a result, investors may shift their funds towards fixed income securities, leading to a potential decline in stock prices. Additionally, higher borrowing costs can impact businesses by increasing their debt burdens and reducing their profitability. The rising interest rates have a profound impact on the nation's fiscal health. As interest rates increase, borrowing costs surge for both the government and private sector. This means that the government will have a harder time paying down its current debt, and that taking on additional debt will cost more money. As a result, the national budget is under stress from the rising interest payments, leaving less money for important public investments and services. The Federal Reserve, which is the nation's central bank, has a big say in how interest rates are set through its monetary policy choices. The Fed strives to maintain a careful balance between promoting economic development and managing inflation, but sometimes its policies have unexpected repercussions. The Fed might tighten monetary policy by increasing interest rates to reduce inflationary pressures. These modifications, however, might have a negative impact on the economy if they're made too quickly or without enough consideration. The impact of rising interest rates and Fed policy extends beyond the government's financial challenges. Higher borrowing prices stifle consumer and private sector spending. When companies need money for growth or investments, the costs go up, which can result in fewer employees being hired, slower growth, or even company closures. Additionally, as people incur higher prices when buying homes, vehicles, or other goods and services, higher interest rates discourage consumer borrowing and spending. The economy's weaker performance has made the country's precarious financial situation even worse. A comprehensive strategy is required to address the imminent bankruptcy threat. First and foremost, the Fed needs to carefully weigh the effects of its monetary policy choices on the wider economy. Clear communication and gradual changes can assist to reduce unforeseen repercussions and offer stability. Simultaneously, the government ought to put economic prudence first by taking action to cut back on expenditure and close the budget deficit. The pressure on the national budget can be reduced by evaluating and reprioritizing expenditures, as well as looking at ways to boost revenue through just taxes. It also becomes crucial to promote an atmosphere that supports economic expansion. The key to boosting economic activity and creating dependable revenue streams is to promote small firms, encourage innovation, and invest in infrastructure. The country can better meet the challenges posed by rising interest rates and Fed policies by strengthening the economy. Despite the overwhelming nature of the crisis, it is important to remember the tenacity and adaptation that the United States has shown throughout its history. The country may prevent bankruptcy by enacting wise policies, encouraging economic expansion, and practicing sound fiscal management, so ensuring a stable and prosperous future for its people. As we witness the growing number of companies filing for bankruptcy, it's crucial to address the factors driving this crisis. What steps do you think should be taken to prevent further economic decline? Share your insights and opinions in the comments below. Thank you for watching, and let's continue the conversation on securing the economic future of the United States.